A powerful economic indicator has just been triggered, and this dramatically increases the probabilities that we're headed straight towards a recession. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over how the yield curve is no longer inverted, which sounds like a good thing until you go back and study how these cycles typically play out throughout history, and then you realize it might not be so good. Let's start by looking at a chart going all the way back to 1990 to today's date. On the left, we go from -3 up to +3. Middle here, 0%. If the blue line goes beneath 0 or is negative, this tells us the curve is inverted. And all that means is that short-term interest rates are higher than long-term interest rates when we look at the Treasury curve. Okay, but then what happens is when we go through this cycle, it's highlighted by these red arrows, the curve uninverts and starts to become steep again. But you'll notice whenever we get one of these red arrows or an uninversion of the curve, it is followed by a recession, a hard landing, a crisis. Nobody knows how it plays out, but a contraction in real economic growth. So this begs the question, well, okay, George, I get this is how it played out in the early 1990s, a recession there, dot-com, GFC, cerveza sickness, but where are we right now? Well, the curve inverted about 2 years ago, but now, more recently, in fact, just the other day, the curve uninverted, meaning the 2-year Treasury yield went below the 10-year Treasury yield instead of the 10-year Treasury yield going above the 2-year. That's a very important distinction. More on that in just a moment. But this just happened. And what's interesting is it seems as though this is going to be sustained because it's been 2, 3, 4 days and the 2-year Treasury yield is still lower. Now, we could see a head fake where it pops back up and goes back and forth for a while, but usually when this happens over the span of 2, 3, 4 days and then sustains over 2, 3, 4 weeks, then we know that we're getting closer, or again, the probabilities are increasing. There are no certainties, only probabilities, but the probabilities are increasing that we're coming closer, or getting closer to that recession. So now let's go over how these cycles typically play out. And by the way, when we were talking about the inversion of the curve, that was the delta between the 2-year Treasury and the 10-year Treasury. So getting back to these cycles, usually the curve starts by inverting, of course. That would make a lot of sense because it has to be inverted to uninvert. You don't need me to tell you that. And then usually you start to get a bull steepener. Now, what is this? This means that the curve is starting to uninvert, but it's uninverting as a result of short-term interest rates going down faster than long-term interest rates. Now, if we had a bear steepener, that would mean that the delta is decreasing between the two, but it's happening as a result of long-term interest rates going up faster than short-term interest rates. And it's a huge difference as far as the signal that the Treasury market is giving us about the overall health of the economy. Then after you get this bull steepening, usually you get the unemployment rate spiking, and we can see that in the Sahm rule, more on that in step number 2. And then the curve uninverts, like we've seen more recently. It stays uninverted, meaning we get past that point where we have those head fakes. And then you see the Fed drop rates, which we're likely going to have here in the next week or two. And this is when we typically get the recession, after the Fed drops rates. Now, it's key that we realize that the NBER, and this is just the official government agency that comes out and says, yes, we are in a recession. But what's interesting is they never really say we are in a recession, because that would imply they're telling us what's happening right now. They always say, oh, we were in a recession. And this recession started, I don't know, about a year ago. So all that stuff we were telling you about not worrying about a recession, just go ahead and disregard that. In fact, let's use 2008, right here as an example. When we had the recession start, right around here, the official recession start, this was January of 2008, right around that time. But the NBER didn't actually announce that we had been in a recession until December of 2008. So my point is, just because they're not coming out and saying that we are in or headed toward a recession, that doesn't necessarily mean there isn't anything to worry about. We've got to completely disregard what the government, the central planners are saying. Shocker, right? And we've got to focus on what the actual Treasury market is telling us about the amount of risk in the system and what they think the Fed is going to be doing with interest rates in the short term. Not because they are preventing a recession, but because they are responding to a recession. Step number 2. Now let's go ahead and look at that cycle we were just talking about through the lens specifically of the unemployment rate, or the SOM rule, which is a derivative of the unemployment rate. We're going to go right over to the Fred website and look at a real-time chart. Now, what the SOM rule is simply a 3-month moving average of the current unemployment rate relative to its lowest point over the past 12 months. So what this has shown is when you get above 50 basis points of a spread, meaning the current 3-month moving average unemployment rate is higher than 50 basis points above the lowest point over the past 12 months, this has told us in the past definitively we are in or headed toward a recession. So what we have to do is we can't just look at one of these metrics or data points. We have to compile all of these data points to tell us, all right, are the probabilities leaning more towards a hard landing or a recession, or are the probabilities leaning more towards a soft landing or no landing? So looking at this chart, we go all the way back to 1960, and we can see, sure enough, every single time we get above a 50 basis point spread, we see a corresponding gray shaded area, which of course is a recession. And now if we combine this with what we were just talking about in step number 1, and that was the yield curve, you can see that this is very powerful, but it's not entirely, it's not 100% accurate. So as an example, a lot of people will point out that right here in the late to mid 1990s, we had an inversion that did not result in a recession. And then a lot of people right here point out that we had a Fed rate hiking cycle in the mid 1980s, and that didn't correspond to a recession. That's another powerful metric that people usually look at, is just the fact that the Fed is going through an extreme rate hiking cycle. So when you combine the fact that we have had a Fed rate hiking cycle, also we have a huge inversion of the curve, and in addition to that, we've not only triggered the SOM rule, but it's gone from 50 basis points to 57 basis points. You see, we're looking at more and more data points that point, no pun intended, in the direction of a hard landing or a recession. Oh, time out. I want to go over another kind of a bonus data point before we get to step number 3. And this is a chart I found recently on Twitter from Dave Rosenberg. And on Twitter, he goes by Econ Guy Rosie. He points out right now we are at an extreme that we very rarely have seen in the past. And this extreme specifically is the Fed funds rate compared to the 2-year Treasury yield. So when the curve is inverted or uninverting, you would expect the 2-year Treasury yield to be under Fed funds. But Jeffrey Gundlach always points out that the Fed funds rate usually just follows the 2-year Treasury yield. So where the 2-year Treasury yield is now can be an indicator for where the Fed funds rate is headed over the near to midterm. So if we look at this chart, we see that we are, in fact, this chart is a little outdated because now the delta between Fed funds and the 2-year Treasury yield is at an all-time extreme. See, right here, it was only about 140 basis points, but we had a bigger spread during the GFC. But now this spread has increased to a level that's more extreme than what we saw prior to the global financial crisis in 2008 and 2009. And this just tells us the market believes the Fed has interest rates way too high relative to the health of the overall economy. Step number 3, but there's more economic signals we have to pay attention to. Now, before we get to this chart of the price of oil, let's go through our little checklist based on how the cycles have played out in the past. So the curve inverts. Check, we've had that. We get a bull steepener. Check, we have had that. In fact, editor, you can go ahead and throw up the last year of what the 2-year Treasury has done as far as the yield gone down relative to the 10-year, and the viewers can see the 2-year has gone down a lot more. Again, bull steepener. And we can see based on what we went over in step number 2 that the labor market is deteriorating quickly. So go ahead and add another check mark. And based on what we went over in step number 1, we see the curve has uninverted. And we know next week the Fed is going to drop rates. So check mark there and check mark there. So what we have to do is say what are the probabilities that this will lead to a recession, and this cycle will play out the exact same way that it's played out 90% of the time going back to, let's just say, the 1960s. So we have to collect as many data points as possible. That's pretty much what this video is all about. So we're going to look at that chart of oil going back to, well, just before July of 2022 to today's date. We go from $70 up to $115, and we can see starting off we're right around 95, and we get this huge spike up. That was when Russia invaded Ukraine. But then it absolutely plummets down to a point where it was just above $70 in the Q1, beginning of Q2 of 2023. It goes up kind of back and forth, but look at what it's done recently. It's absolutely collapsed in price to the point where now it's under $70 per barrel. Now, usually this in and of itself wouldn't be a big deal. But what we also have to consider are the production cuts that we have had along the way from OPEC, ironically, trying to prop up the price. Editor, go ahead and cut to this clip from a recent Macro Voices episode.
The current amount of supply that OPEC is withholding from the market, roughly 4 million barrels a day of realized tangible cuts relative to October 2022 levels when this new cutting cycle restarted again. That's the most crude that OPEC and OPEC Plus is withholding from the market since the 2008-2009 financial crisis. These are crisis-level production cuts.
So we know the price of oil is simply a result of supply and demand, and that supply has been massively restricted. In fact, to use their term, we have never seen this type of restriction outside of a crisis. So we have to ask ourselves, okay, well then what's happening with demand? If they're pulling back the production, and this would even include the increase in production that we've seen in the United States. So on net balance, it's still a decline, and just being overly optimistic, it would be flat. But then we say, okay, well, if the price is plummeting like this, what does it actually tell us about the demand side of the equation? Well, to answer that question, editor, go ahead and throw up this recent article from CNBC where Morgan Stanley cuts oil forecasts and says that traders are pricing in a demand slowdown similar to a mild recession. And I'd like to remind everyone watching this video that energy is the economy. And therefore, the amount of energy we're using, or the demand for the energy, is a very good representation as to what's happening with economic output and whether it's accelerating or contracting. So when you put all of these things together, and I could give you a list of another probably 100 items that we could say would lead you to believe the odds are favoring a recession. But when you just look at what interest rates are telling you, when you look at what the unemployment level is telling you, the SOM rule as an example, and you look at what commodity prices are telling you, you have to say the base case is a hard landing and not a soft landing or a no landing, although it's just a matter of probabilities and there are no certainties. But I did forget one data point, and it's probably the most important data point of all that would suggest we're not only headed for a recession, but we could even be headed for a financial collapse. Editor, go ahead and play the video.
A lot of stocks are trading as if we're going to have a big recession, and we're not going to have a big recession.
So if Jim Cramer is in the no recession camp, you know that just based on that data point alone, we're likely headed or on the brink of an economic collapse. No, in all seriousness, guys, this video is all about encouraging you to not just look at the bearish data or the bullish data, but look at everything that we have access to and come to your own conclusions as to what you think the most likely outcome is going to be. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.